It starts the same way for almost everyone. You open your phone, check the markets, and see green everywhere. People on social media are bragging about doubling their money on Nvidia, Tesla, or some mysterious new AI stock. You think, maybe I should invest too. Then you scroll down and see someone else lose half their savings overnight. The same stock, same market, different outcome. So you ask the real question: how does anyone actually make money here without getting lucky? 2026 isn't 2020 anymore. Back then, you could throw money at almost anything and watch it grow. The market was drunk on cheap money. Now, interest rates are higher, inflation is sticky, and investors are sober, painfully so. But here's the twist. This is actually the best time to learn, because when the hype fades, the real rules start to reveal themselves. And understanding those rules, not the headlines, is how beginners quietly become serious investors. Let's strip away the jargon. The stock market is not a casino. It's a place where ownership gets traded, tiny pieces of real companies. When you buy a share, you're buying a fraction of a business, not a lottery ticket, not a trend, a business. Imagine owning 1/10 of your local grocery store. If the store grows, your piece becomes more valuable. If it shrinks, you lose value. Now scale that to New York Stock Exchange, NASDAQ, or even global markets. That's all it is. Before you buy anything, you need to understand the 3 layers of the game. Layer 1, the broker. This is your access point. Platforms like Fidelity, Charles Schwab, or Robinhood, they connect you to the market. Layer 2, the assets. Individual stocks, index funds, ETFs, each one carries risk. Some are rockets, others are slow but steady trains. Layer 3, your psychology. This is where 90% of people fail, because markets don't just test your money, they test your patience, and every investor eventually faces the same emotion: fear during a fall, greed during a rise. The best investors, they don't eliminate emotion, they plan for it. Let's say you're starting with $1,000. Here's the boring but powerful way to begin. First, build your foundation, an emergency fund that's not in the market. Second, open a brokerage account. Third, don't pick individual stocks yet. Instead, buy something that tracks the entire market, like an S&P 500 index fund or a total market ETF. Why? Because you're buying a slice of 500 companies instead of betting on one. That's not diversification, that's survival. This is how you learn how markets move, safely, slowly, without blowing up your account. Here's the part most beginners miss. You don't make money when you buy. You make money while you wait. If you invested $10,000 in the S&P 500 in 2003 and did nothing, no trading, no panic selling, you'd have over $66,000 today. That's an average of 10% annual growth. Now, if you missed just the 10 best days of those 20 years, your return drops almost in half. The uncomfortable truth? Timing the market doesn't work. Time in the market does. You'll see videos promising secret stocks or AI picks for 2026. Ignore them, because the real secret isn't a stock, it's a system. A consistent, boring, automated plan that removes you from your own bad decisions. Dollar cost averaging, investing a fixed amount every month no matter what, is one of the few proven strategies that beats most experts over time. It's not exciting, but neither is compounding until it quietly changes your life. Here's the irony. The best investors aren't chasing money, they're chasing time, the freedom it buys. Every share you buy is a tiny bet on human progress, on people waking up tomorrow to build something valuable. That's what markets really are, a mirror of our collective ambition and mistakes. So the next time someone tells you the market is too risky, remember, not learning how it works is riskier. Because whether you invest or not, you're already in the game. You're just deciding whether to play consciously or by accident.